one more important question, right? Very, very important, very square important. I'm going to dictate the question and then we will solve. Very important question for your upcoming exams. Write down Pfizer Inc. Pfizer, Pfizer. A US based company. A US based company has received an offer from Serum Institute Limited to set up a manufacturing unit in Pune, India, in a joint venture to manufacture vaccine for coronavirus. The terms of JV, write down. Pfizer Inc. will receive 55% share of revenue, plus a royalty at the rate of $0.01 per bottle. Next, write down initial investment. Rupees 200 crore for machinery. This is rupees, okay, not dollar. Rupees 200 crore for machinery. Next line, scrap value of machinery. At the end of 5 years. Rupees 5 crores. Scrap value of the machinery at the end of 5 years, rupees 5 crores. Next line, the machinery is depreciable. At the rate of 20% on the value net of salvage value. Using straight line method. First write down the question, then we will discuss. Next line, an initial working capital to the tune of rupees 50 crore. Shall be required, and thereafter rupees 5 crores each year. Next line, write down. The question is not over. Next paragraph, as per GOI directions, Government of India. As per GOI direction, it is estimated that the price per bottle will be rupees 7.50. And production will be 24 crores bottles per year. The price in addition to inflation of respective year shall be increased by rupees 1 each year. The production cost shall be 50% of the revenues. 40% of the revenue. The production cost shall be 40% of the revenue. Next line, write down. So this is about your revenue and cost. Now they are saying the applicable tax rate in India is 30%. The applicable tax rate in India is 30% and 35% in US. And 35% in US. And there is a DTAA. And there is a DTAA, Double Taxation Avoidance Agreement, DTAA, between India and US. There is a DTAA between India and US. According to the agreement, tax credit shall be given in the US. Tax credit shall be given in US for tax paid in India. Tax credit shall be given in US for the tax paid in India. In both the countries, taxes shall be paid in the following year. Taxes shall be paid in the following year in which profit have arisen. So this I will underline. Taxes shall be paid in the following year in which profit have arisen. Taxes shall be paid in the following year in which profit have arisen. So tax will be paid in the next year. Calculation will be done in this year. Actual payment will be in the next year. And now about exchange rates. Next line, the spot rate of dollar is rupees 57. The inflation in India is 6%. The inflation in India is 6%. In bracket, expected to decrease by 0.50% every year. Expected to decrease by 0.50% every year and 5% in US. So US will remain constant. India's inflation will be 6, 5.55. This way it will decrease. As per the policy of GOI, all adjustments in one problem on this chapter. As per the policy of GOI, only 50% of the share can be remitted in the year. Only 50% of the share can be remitted in the year in which they are earned. Can be remitted in the year in which they are earned and remaining in the following year. And remaining in the following year. So 50% of the cash can be remitted in the same year, 50% will be remitted in the next year. Next line, though WACC, what is WACC? Weighted average cost of capital. Though WACC of Pfizer Inc. is 13%, but due to risky nature of the project, it expects a return of 15%. Now the last line. Due to risky nature of the project, it expects a return of 15%. Question, determine whether Pfizer Inc. should invest in the project or not. And they have given one something in bracket which is of no use from subsidiary point of view. This line is of actually no use. You have to evaluate whether it is worth investing in this project or not by keeping in mind the amount invested and the cash flow generated. The cash flow will be discounted at 15%, and if the NPV is positive, you will go ahead. So let us now read the problem one more time for you, and in case if you have missed out something, you can read. So there is a US company Pfizer, there is an Indian company Serum Institute. They want to set up a joint venture in India to manufacture coronavirus vaccine. The terms of the joint venture, that this company Pfizer will get 55% share in revenue and plus a royalty which is equal to $0.01 per bottle. Then initial investment 200 crore, scrap value 5 crore, depreciation is 20% on the net salvage value. So net salvage value will be 200 minus 5, 195 into 20%, whatever is that will be the annual depreciation. And see about the working capital. Initially the working capital will be 50 crore and working capital will increase by 5 every year shall be required, and thereafter rupees 5 crore each year. So you have to keep on adding 5 crore more in working capital. Okay. So total working capital you have to invest is 50 in the initial year, then first, second, third, fourth to 5 each, and in the fifth year once the project is over, the working capital will be fully recovered. So while calculating recovery of working capital, we have to consider the initial investment in working capital plus additional working capital, and all of these will be fully recovered. Now see the Government of India direction. It has put a cap on the price that it will be 7.50 and you can increase it by 1 rupee every year subject to inflation. So this is your base price, and then you have some inflation given. So after adjusting for inflation, you will decide the selling price per bottle. You are allowed to increase 1 rupee on the base price subject to inflation also. The price in addition to inflation of respective year, underline, in addition to inflation of respective year. So that year inflation you will add shall be increased by 1 rupees, and the production cost will be 40% of the revenue. The production cost will be 40% of the revenue. So this will help us to calculate what is total revenue, share in revenue, share in production cost for the Pfizer company. Tax rate in India 30%, US 35%, there is a DTAA. So whatever is the tax paid in India, you will get the credit for that in USA. So we will calculate US tax liability minus tax already paid in India. The remaining amount will be paid in USA. One more important thing, tax shall be paid in the following year in which profit has arisen. So in year 1 we will calculate profit earned by Pfizer, tax, suppose profit is 100, tax is 30, the actual payment will be in the second year. Second year tax liability suppose 35, the actual payment for cash flow purpose, because ultimately NPV will be based on cash flow, not on profit. So for cash flow calculation, this will be treated as payment in the next year. So that will require some carefulness, otherwise you can make mistake, and this is given for calculating the expected spot rate in the next 5-6 years. So spot is 57, inflation in India 6%, but inflation will decline by 0.50 every year. So while calculating the expected rate, The inflation you will take will be 6%, 5.5% and like this. But in USA, the inflation will remain 5% in all the years. What about the remittance of cash flow? As per Indian government policy, 50% of the share of Pfizer can be remitted in the same year, but 50% will be remitted in the following year. And then for discounting purpose, even though the cost of capital is 13%, but because there is a risk involved, they want to evaluate the project using a higher discount rate of 15%. So whether this company Pfizer should invest in the project or not. So a very good question. It takes into account many aspects of international capital budgeting. It takes into account the inflation, exchange rate, taxation, working capital, depreciation, remittances, part remittance, DTAA, etc. So first thing we'll start with is to calculate the exchange rate. Draw this format: year, calculation, exchange rate. In exchange rate column you can write rupees per dollar. Keep the question in front of you. Very important question. It can be asked for up to 16 to 20 marks. Don't be surprised. First thing, exchange rate. Year 1. Year 1. The formula write down here. Forward rate is equal to spot rate into 1 plus ID upon 1 plus IF. This ID stands for inflation in India and IF stands for inflation in USA. IF stands for inflation in USA. This formula is derived from purchasing power parity theorem. So in bracket write down as per purchasing power parity theorem. As per purchasing power parity theorem. Now we'll start solving. Next few seconds will be easy for us. First you write down the spot rate 57 into 1.06 divided by 1.05. So that is 57.54 rupees per dollar. Now this will be taken as spot rate or base rate for next year calculation. So take 57.54, keep calculator ready, but be careful, this inflation in India will fall by 0.50% every year. So next year inflation is expected to be 1.055. So be careful because this inflation in India will be changing, USA will not change. So now the answer is 57.82, then 3, 57.82, again the inflation will change into 1.05 divided by 1.05. So this 2 will cancel, no need to calculate. 57.82 again, 4, 57.82 into 1.045 divided by 1.05. So 57.54. Year 5. Year 5 will be 57.54 into 1.04 divided by 1.05 divided by 1.05. So this is 56.99 and year 6 write down 56.99. Some students are asking a question that why we have taken 6 years. why we have not taken 5 years. So you have to think about it, and that is where the student's intelligence lies, planning in advance. The fifth year 50% revenue, the fifth year 50% amount will be transferred in the sixth year, because the law of the country says you can only remit 50% of your share in the same year and 50% in the next year. So fifth year 50% amount will be transferred in the sixth year. So in sixth year also there will be cash inflow in US, okay, and hence sixth year is also required, because from US company's point of view some cash flow will also be received in the sixth year. So therefore the sixth year cash flow in rupees needs to be converted into dollar. So hence we will require this sixth year exchange rate also. So this way you first compute the exchange rate. I hope this working is clear. Now the next step number 2, share of Pfizer Inc. Share of Pfizer Inc. The name of the company Pfizer in sales. Share of Pfizer Inc. in sales. Share of US company Pfizer Inc. in the sales. So for that I need to first calculate the sales amount of the 5 years. The amount will change because the rate is changing, price per bottle is changing. Right hand side 5 columns. Right hand side 5 columns, and then write down point number A, sales in units, in crores. So the question says this company will have to manufacture 24 crores bottles every year. So at the top also you write down rupees in crores. Now write point number B, price per bottle in rupees. Price per bottle in rupees. This is like base price. Base price. That will be subject to inflation. The government has allowed you to start with 7.50 per bottle and then increase it by 1 rupee. So it will be 8.50, 9.50, 10.50, 11.50. Those students who want to show calculations can write why it is increasing by 1 rupee. It's given in the problem. Then after every line keep one line blank. Point number C, write down inflation rate. Inflation rate will be 6%, 5.5%, 5%, 4.5% and 4%. So this is decreasing by 0.5% every year. And the problem says inflation rate will be applied for the respective year to the base rate. So now I will calculate the inflated price or price including inflation. Price including inflation will be 7.50 plus 6%, 7.95. 8.50, take the base price of that year and plus the inflation, 8.97. 8.97. Some of the student can also think like this, that this answer is wrong. It should be 8.50 into the first year inflation and then also into the second year inflation. So the answer is no, we have to take only the base price of that year and inflation of that year. That is what they have mentioned. Hence I will not take cumulative effect of inflation. I will not take cumulative effect of inflation. Now take 9.50 plus 5%, 9.98, 10.50 plus 4.5%, 10.97, 11.50 plus 4%, is 11.96. 11.96. So these are the rates. Those who want to show the calculation, you can show calculation in one or two columns. We have to take base price plus inflation of that year. In this case, we will not take the cumulative inflation. Then point number E, write down sales revenue, total sale revenue. This is total. A into D. A into D. Now see, 24 is common number to multiply. So how to save time? First time multiply 24 into 7.95 equal to, you will get 190.80. Now just type 8.97, press equal to, you will get 215.28. Type 9.98, press equal to 239.52. Again 10.97 in equal to, so we should know how to save time. 263.28, 11.96 equal to, so 287.04 approximately. In 2 digits we have written. The sale revenue is rupees crore. Sale revenue I have written at the top rupees in crore. Now point number F, write down Pfizer's share in sales. Pfizer's share in sales at 55%. Pfizer's share in sales at the rate of 55%. As per the joint venture agreement, they will get 55% share in the sales. So again 0.55 is the common multiplier. See how to save time. First time type 0.55 into 190.80 equal to 104.94. Now only type 215.28 equal to 118.40. 239.52, press equal to. You will see the magic. 131.74. 263.28 equal to 144.80 and 157.87. So this is one important calculation we have got. Share of Pfizer in sales. Point number G, write down royalty per bottle in dollar. Royalty per bottle in dollar. So in the heading you also add share of Pfizer in sale and royalty income. So royalty per bottle is $0.01 is written in dollar, but this is dollar, this is rupees, you can't add them. So I will first calculate total royalty in dollars crore, because you are going to multiply by dollar quantity. 24 into 0.01, 24 into 0.01, A into G. Write down the working, A into G. So you will get 0.24 crores dollar, and this you repeat because both numbers are constant. 24 and 0.01 both are constant. So in the exam, be careful, they might just say that royalty will be 0.01 in first year and 0.02, 0.03, etc. Or they can increase the quantity manufactured in each year. So accordingly, your calculations you have to manage. Now this is the royalty in dollar. This is the share in sales in rupees. I can't add them. So I need to convert them into rupees right now at exchange rate already calculated for first 5 years. So dear student, write down point number I. Exchange rate in bracket step 1. Exchange rate step 1. 57.54. 57.82. You can go in the step 1 first 5 year. 57.82. 57.54 and 56.99. Now you can convert this into rupees. Now this exchange rate, in just bracket write down rupees per dollar, rupees per dollar, and this amount is in dollar, rate is rupees per dollar. You will multiply. So point number J, total royalty in rupees crores, total royalty in rupees crore, H into I, H into I, H into I. Now here also see 0.24 is the common multiplier. First time 0.24 into 57.54 equal to, right, 13.81. Just type 57.82 equal to 13.88. Same number, same answer, don't try also. 13.88, be alert. Next 57.54 equal to 13.81 and 56.99 is 13.68. When inflation in India was high, exchange rate was high. But when inflation in India became lower than USA, the exchange rate also became lower than USA. So that is just for understanding. And now, what is the total income of this Pfizer company from this business? This is their total income. So add the share in sale, add the royalty, so that will give them total income from Indian operation, of course subject to expense and tax, subject to expense and tax. So total income, write down total income, F plus J, F plus J, 118.75, 132.28, 145.62. Keep adding. Next one, 156.8061. It should be 158. 158. 158.61. Maybe a typing error. 158.61. And then write down last one, 171.55. 158.61, 171.55. So this is their total income. Now we'll calculate their tax liability in India. Now we'll calculate their tax liability in India, because they have to pay 30% tax in India. So step number 3, tax liability and cash flow in India. Tax liability and free cash flow or cash flow in India. Tax liability and cash flow in India. This time I will write 0, 1, 2, 3, 4, 5, 6. Sir, why you have written 6 also? The 5th year tax will be paid in the 6th year. 5th year tax liability will be paid in the 6th year. That is why. So this will give me a complete idea as to what is the cash flow involved in this problem. So write down 0, 1, 2, 3, 4, 5, 6. These are years. First point A, total income. Total income of Pfizer company as per step 2. Total income of Pfizer company as per step 2. Go to last line of previous step. Income write down first. 5 income figures write down. $118.75, 132.28, 145.62, 158.61, 171.55. Production expense. Production expense will be, they will share also expense. Production expense is 40% of sale. Production expense is 40% of sales. So their share in sale multiplied by 40% will give us their share of the production expense. Will give us their share of the production expense. So sales figure we have calculated in step number 2. Sales figure we have calculated in step number 2. So you have to go to step 2 and search for the sales figure. Share in sales figure 104.94. I will show you, but then I have to go to the previous slide. This is that figure. Can you see in the center Pfizer sale in sales? So take this line, take this entire line and multiply by 40%. So that will give them their share of expense. So take 41.98, put in bracket indicating outflow. Next one, 118.40 into 0.4, 47.36. Next one, 131.74 into 0.4. This is their share in production expense of third year, 52.69. Then 57.92. 57.92. Keep checking the calculation. 63.15. Do not multiply it by this figure. First A, because it includes royalty also. Only we need to multiply by sales figure. Now point number C, depreciation. Depreciation is required for tax calculation, otherwise it is a non-cash item. So 195 into 20%. 195 into 20%. Why 195? Why not 200? Because 5 is scrap value. On net salvage value, we have to apportion. So just calculate once 39 and copy 5 times. Then write down PBT. PBT. This is their income now. Income of Pfizer company. So PBT A minus B minus C. So take your calculator and do it. 118.75 minus 41.98 and minus 39. So we are getting 37.77. Try the next one. A minus B minus C. 45.92. 45.92. 53.92. 53.92. Next one, 61.69. 158.61 minus 57.92 and minus 39. So 61.69. And now the last one, 69.40. 69.40. This is PBT in India, and on Indian income the tax rate is 30%. On Indian income the tax rate is 30%. So type on your calculator 0.30 into 37.77 equal to, you will get 11.33. Again type 45.92, press equal to 13.78. Type 53.92, press equal to 16.18, 18.51, 20.82. Up to this is right. So we can also calculate net profit D minus E. 26.50, 26.44, 32.14, 32.14. Third year is how much? 37.74. Okay. Fourth year 43.18. fifth year 48.58. Now one important thing in this question is this tax which you have calculated here, we are not going to pay in that year. As per the instruction, the tax of first year will be paid in the second year. Tax of second year will be paid in the third year, and likewise have to pay the tax but in the next column, and that is where the column number 6 will be required now. So now write down this 11.33 tax, put in the second year column, and for your future reference you put an arrow mark also that this is paid here. This is only for calculation. Tax will be based on income of this year. So for this year this is my liability. So this is liability, but the payment will be made in the subsequent year. The liability is created in the first year, but the payment is in the next year. Same way you write here with the help of this arrow. Continue yourself. 16.81 and this 20.81 is paid here. So all payments I am writing in bracket, all inflows I am writing as a positive number. Now in addition to these inflows and outflows, there is another outflow, initial outlay 200. Initial outlay 200 and working capital. This is normally we solve a question of capital budgeting by preparing this year wise table, write all the cash flows and then find NPV. Working capital is written 50 will be required today, 5 will be required in every year. So this 50 will be required for actually first year's operation. This additional 5 will be required for second year operation. This additional 5 will be required. You will invest at the end of year 2, but it will be required for third year. This will be required for fourth year, and this is for fifth year. Now the question is, should I write minus 5 here or not? Should I write minus 5 there or not? The answer is no, because we already have enough working capital for fifth year operation, and now in the fifth year we are winding up the operation. So why we will put additional working capital? So the answer is we will not. Rather, all the working capital invested will be recovered, and that is 70. Now one more thing, in case if you want to write 5 here, the recovery will be 75. So what is the effect? 70. There are two ways you can write working capital 5 if you want to write, which is wrong actually, but then you have to write the recovery as 75 because 50 and 5 times 5. So working capital will be recovered at the end of year 5. So my net cash flow of working capital will be 70 inflow in the fifth year, any way you present. And there is one more thing, scrap value. Scrap value will be positive 5 in the last year. Positive number 5. All these colors, all these numbers which are having a background in color, these represent inflows and outflows. These all represents inflow or outflows, whatever. Bracket indicates outflow and positive number indicates inflow. So now what I'll do, I will calculate what is the cash flow earned in India or generated in India, but of course this cannot be taken fully in the same year. It is generated but not repatriated. So cash flow generated in India, cash flow generated in India, you have to take A, which is inflow, minus B, which is production expense outflow, minus G, which is payment of tax, minus H, which is initial outlay, then plus minus I, because sometimes there is an outflow, inflow, so minus plus or plus minus whatever, and last plus J, which is scrap value, will add. In any case, we have written negative number or outflow in bracket and inflow in positive. So that also will ensure you will not make mistake in calculation. So all these rows which have a background color, you add or less whatever you want. Like year 0 we have outflow 250, year 1 will have 118.75 minus 41.98 and this minus 5. So you'll get 71.77 positive. And then we have inflow, then minus production expense, minus tax payment, minus additional working capital required. So the net effect is 68.59. Try the next year on your calculator. 145.62 minus 52.69 minus tax paid 13.78 minus working capital 5. Answer, yes please, 74.15 approximately. Fourth year, 156.61 minus 57.92 minus 16.18 minus 5, 74.15. Last year, fifth year, main calculation here, 171.55 minus 63.15 minus 18.51 plus 70 plus 5. This last two number plus plus. So your answer will be 164.89, and the last year is very easy, 20.82. The story is not over. These are the cash flows. Now they will not, this of course you have to invest in year 0. This of course you have to invest in year 0, so don't take 50-50 of this. And this also don't take 50-50 of this. This is the tax which you have to pay in India in the 6th year. So this 5 year, which is actually the cash flow that belongs to foreign company, the government says you will take half in the current year and half in the next year. So now we will calculate the remittances of cash flow. Remittances of cash flow. This is what cash flow US company will receive. So for their evaluation purpose, the timing of cash flow at which they are going to receive the payment is important rather than the timing of cash flow it is generated in India. So therefore write down step number 4, remittances of cash flows. Remittances of cash flows. Because time value of money will make an impact, plus exchange rates are also changing. So that will impact the answer, time value of money and exchange rate. Serial number, particulars, year 0, 1, 2, 3, 4, 5, 6. Year 0, 1, 2, 3, 4, 5, 6. Draw lines if you want to draw lines. I will appreciate if you draw lines. Notebook would look neat, clean. People will appreciate your notebook. People will also ask who is the teacher. Now, first line you copy this last line of the previous table. This is the cash flow generated in India, and accordingly we will prepare this table. Cash flow generated in India, in bracket step number 3. First number you have to spend in year 0. Last is the tax payment. So what we are going to bifurcate is these cash flows. These cash flows. 50% in the same year and 50% in the next year. So write down 50% of current year cash flow. 50% will be paid in the same year, but not all the 6-7 figures, only these 5 figures. Take 50% here, 50%, 50%, 50% and 50%. And then previous year remaining cash flow. Previous year remaining cash flow. Now understand, in year 1 the total cash flow generated in India 71.77. This much we have already remitted. This much we have remitted. So balance amount will be remitted in the next year. So take 71.77 minus 35.89 is 35.88 will be remitted in the second year. Continue. 68.59 minus 34.29, so 34.30 remitted in the next year. 74.15 minus 37.07 is 37.08. 74.15 minus this, or you can take half of this, but then if you take half the total will not match, so just be careful about it, otherwise there is no problem. And the last one 82.44. I think this number we have typed wrongly, it is 79.51. 79.51, maybe some typing error. So these are my remittances. So my total cash flow from US company point of view will be, now look at the question from US company's point of view. Year 0 they are going to invest 250, and you write here in the top right hand side corner rupees in crores. Rupees in crores. And then this is their inflows. First year 35.89, 70.17, 71.37, 76.84, and this you add here 122.20. Only add these two numbers in the year 1, 2, 3, 4, 5. Whatever I have written in color, that is the cash flow of US company, right? So purposefully this color coding is done to understand this is the outflow, these two are inflows, and these two are outflow and inflow of the 6th year. So the 6th year would be 61.62. 61.62 because there is some tax payment to be made in the 6th year. So out of this remaining amount, this tax will be paid and balance amount will be remitted in the 6th year. So these are, you can say, your basically a simple problem of capital budgeting from the US company's point of view. But still the complications are not over. On these inflows, they will have to pay tax in US at 35%, and they will get tax credit for whatever taxes which have been paid in India. They will get tax credit for whatever taxes which have been paid in India, and therefore some more complications are pending. And don't forget, we have computed the answer right now in rupees. We have to convert into dollar. So that is also one thing. After converting into dollar, we will calculate the US tax less the tax liability already paid in India. Remaining tax will be paid in USA, and then we will get the NPV. So have patience. Now we have come to the last working note. NPV of the project. Serial number particulars 0, 1, 2, 3, 4, 5, 6. Write down this table. I will recommend you draw the lines because there are so many columns, so you should not feel confused later. And write down total remittances, rupees in crore. You will just go to the previous working note and copy these numbers. So bracket write step 4. This will tell you how you are getting the answer. This you write rupees in crore. Here you just write down figures in crore because some figures are in rupees in this table. Some figures are in dollars. So point number B, exchange rate. Where is the exchange rate? Step 1. What is the format of exchange rate? Rupees per dollar. So again go to step 1 and search for these rates. So that is why we had calculated the 6th year exchange rate also, because some cash flow will arise in the 6th year. Some cash flow will arise in the 6th year also. So this is rupees, this is rate per dollar. So I need to divide to convert into dollar. So point number C, remittances in USD. Remittance in USD, A by B, dollar crore. So 250 divided by 57. So your initial investment was 4.386 crore dollar. If you want to write in million, you have to multiply by 10. If you want to write in lakhs, you have to multiply this number by 100. Choice is yours. We will prefer to write in crores. So whatever is the number given, based on that we are writing the calculation. Chances of mistake will not be there. Next one, 0.624, 1.214, 1.234, 1.335, 2.144 and 1.097. So this is the remittances in USD. Then US will charge you tax at the rate of 35%. So first we'll calculate tax accrued here, tax accrued, and then tax paid. Accrued means based on this amount they have ultimately received, what is their tax liability in USA, but the payment will be made in the subsequent year. Payment will be made in the subsequent year. So in USA, your tax liability will accrue at the rate of 35%. So first you write down accrued in the year in which you receive the remittances. 0.62, you type on calculator 0.35 first, 0.35 into 0.624 into 0.624, 0.218. Then just type 1.214 equal to 0.425, 1.234 equal to 0.432, 1.335 equal to 0.467, 2.144, 0.750, and this is 0.384. Now we'll write down actual payment of tax. Actual payment of tax. Actual payment of tax in the next year. Like we did in the earlier calculation, this you transfer here, this you transfer here, then this you transfer here, this you transfer here, this you transfer here, and now write down Indian tax paid. Indian tax paid, step 3, but Indian tax paid is rupees in crore. Again there is a problem. Step 3, if you go, there is one tax paid, actual tax paid written, rupees in crore. Actual tax paid is written there, rupees in crore, and these are the tax paid in rupees in crore. You have to go to step 3, not 4, step 3, where actual tax paid is written somewhere in the center of that table. I'm sure you are able to locate it. I'm sure you are able to locate that. So this is your tax paid. Now come to point number G. This is in rupees. I need to convert into dollar. Exchange rate already is written in point number B. So please write down income tax paid in dollar crore. Income tax paid in dollar crore F by B. F by B. Because this is in rupees crore. This is in dollar crore. How do I compare? So I have to divide this by the exchange rate of that year, that is your 57.82. So try 11.33 divided by 57.82. So you are getting in dollar terms 0.196. Got it? 0.196. Now take this number, divide by this number 0.238. Take this number, divide by this number 0.282. 18.51 divided by 56.99 is 0.325, and then 20.82, 56.18, that is 0.371. 0.371. So now what is the net tax to be paid in USA? Net tax to be paid in USA. Net tax to be paid in USA, E minus G. E minus G. Tax liability in USA minus the tax paid in India. So the difference between the two is, just check 0.022, 0.022, 0.187, 0.150, 0.142 and 0.379. Do the calculation yourself. Once you practice yourself, it will increase your confidence. So this less this. This is what we are doing. So are you getting these answers? Yes. Now we have almost reached the answer. Therefore net cash flow in dollar. Therefore net cash flow in dollar. Now I have highlighted two lines. This point number C, which is your cash flow, and this is your tax, some additional tax in USA. So first figure same, second figure also same. This one C minus H, only these two lines, no other lines you have to consider. And then this is 1.192, 1.047, 1.184, 2.002 and 0.718. So after so much of hard work, now finally we are reaching our destination. So last line will be, this figure is in bracket, last line write down present value at the rate of 15%. Present value at the rate of 15%. So first number will be same. Now use memory function also to save our time. 0.624 divided by 1.15. 0.543 memory plus. 1.192 divided by 1.15 two times. 0.901. 1.047 divided by 1.15 three times equal to memory plus 0.689. 1.184 divided by 1.154 times equal to memory plus 0.677, 2.002, and then divide by 1.1535 times equal to 5 times equal to memory plus 0.995, and the last one 0.718 divided by 1.15, 6 times equal to, so 0.310 memory plus memory recall minus initial outflow 4.386. So you will be getting something close to dollar minus 0.271 crores, very close to zero, but still it is negative, and because the student will get negative answer, the advice will be project should not be accepted. Project should not be accepted because the NPV is negative. The project should not be accepted because the NPV is negative. The project should not be accepted because NPV is negative. This answer is over.